Hey, this is Garrison Comstock here, back to give you the deep dive for this month for August here in 2020 into the market statistics here in the South Bay. Let's get right into the market statistics. Let's go here, share, and then I will present. Boom. August 2020. So last month we had the June stats, or had the May stats, and then the July stats. This month we have the June and July. As you can see, the closed listings in July jumped up this month. So we had in May, we had new listings jump to over 500. In June, we had new listings jump to over 500, but we still maintained a 3-month supply. So we've been watching to see if we ate up all these new listings. And we did. We jumped up to 526 closed here, and I would imagine we'd have the same next month, judging by what I'm seeing out there in the market right now. And then pending 340, similar as well. So as fast as they're coming in, we're kind of eating them up. New 674 this month, and month supply 3.2. This is the important number. This means that if no more listings came out on the market tomorrow, how many months would it take us to eat them up? 3.2 is the way it is right now. A 5 month to 6 months, so 5 to 6 in this number right here would be a healthy market, 3% appreciation, 3 to 5%. Anything less than that is a seller's market. Anything over that is a buyer's market. So over 6 months, when we have a lot more inventory than people want to buy, right? It's basically measuring the level of supply versus the level of demand. The average percent of list price is 98%. It's staying right there, pretty consistent. That's great to know, because to keep a 98% average, that means a lot of places are going over list price. And we see that here as well, with the median days on market actually dropping. So we've eaten these properties up faster, or more sales than we did the last couple months. And we did it quicker at 13 days on market. So for those of you that view this 674 and think that, oh man, we're getting more listings, we're actually jumping up, there's more people coming for sale on the market, and this is a bad thing, I put this next slide in here for you. This shows the rhythm of listings by month every single year. So as you can see, it's relatively consistent year over year ever since 2009. Boom, 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 boom. We usually start, we get the most listings in April, May, June, and then we usually start to go down in July. So July is usually one of these right in here. This is usually July. This is usually July. As you can see, July last year was on the back half of this. And it bottoms out. This is always December. December of every year is just down here, because the holidays, there's just less listings coming out on the market. This is new listings. So this is July right here. This is our 670. It's right on level with what we usually get in July. Just usually we hit a peak here and we're coming down. But we went December, we went January, February, March, or January, February, and then March, April, May, June, July, something like that. We kind of had this little medium session here where no new listings came out in the market. So we move forward, looking into the economy and what's been happening. This is what everybody predicted, or I guess the major financial institutions predicted a few months ago when this all started. Goldman Sachs, JP Morgan, they predicted this V right here. And I'm going to show you a couple slides now that show that the V is kind of already starting to happen, which is good news, everybody. In the United States, total spending by all consumers as compared to the first of the year. Normal, normal, normal. We don't want to spend. And then we start spending a little bit more. We start spending a little bit more. July 1st, we're spending a little bit more. So we started to spend, which means, consumer confidence is growing a little bit. Also look at the industries, spending per industry compared to the first of the year. About beginning of March, ducktail. Well, let's call a spade here. Groceries have done great throughout this whole situation, but apparel, total bottoming out, and then we've come back up. It's not minus 4.2% now from where we started. So people are buying apparel again. That's I don't want to say a luxury spend, but spending that isn't a necessity. Healthcare, restaurants and hotels, arts and entertainment, and transportation. They all bottomed out and they're all starting to rebound. We're starting to see this V here that was predicted. Same thing with the housing market recovery index, which combines supply, demand, price, and time on market. It seems we're getting back to the baseline. I think this also has showings in it as well. because we haven't seen really much of this here in the South Bay. This is a nationwide statistic here, but in the South Bay, we've stayed pretty consistent throughout. But showings in North America, as you can see, hey, we got showings, middle of March, boom, less showings, but starting to come back up, and then they normalized, and now we're back at more showings than we had at the beginning of the year. But the more interesting slide with regards to this is purchase applications. Not only are we having showings, but people are filling out loan applications in order to purchase these homes. Purchase applications, and this is year over year. This isn't even towards January 1st or February 1st where sales are down a little bit in the first place. This is year over year. We've had 10 straight weeks of a year over year increases. And as you can see, once again, mid-March went down, but then right back up, and 10 straight weeks, every week, we've had more purchase applications this year nationwide than we did last year. So this is a fantastic little graph. So everything seems to be coming back. We're seeing this V, right? The V is everywhere. And this is new builds. New builds is not necessarily super important here in the South Bay because we don't have any large subdivisions, but the National Association of Home Builders have their confidence index, and their confidence index is back to where it was at the beginning of the year. So builders feel good again building new properties for homeowners nationwide. So what about unemployment? Well, let's take a look at the numbers. This is the headline you'll see in the news: 51 million unemployed, cumulative new filings, right? So this is every month there's new filings. There's 6 million more. There's another 6 million right there. And as they go up, and it's a total of 51 million. But the interesting stat here is that right about early May, we started to see a decline in actually collecting unemployment insurance. Decline in unemployment insurance collections. So that means there are more people coming off of unemployment than are going on. So doesn't mean like this number is still too high. 16 million unemployed is not fun, but it's good to see the trend line coming down. And this is another, it's just the same graph, but as a trend line. So the consensus was we're going to have a bunch of jobs added in June. We actually added a lot more than that, 4.8 million new jobs. That's part of the reason that unemployment's coming down, which is fantastic. The economy gains 4.8 million jobs. Employment gains, losses by sector. This is a U.S. Bureau of Labor Statistics stat. It's great. The unemployment rate, as reported, it went up, right? Went huge in April, May, and June. But then once again, we see this coming down here in April, May, and June. So everything's getting a little bit better. Breakdown of the U.S. Bureau of Labor Statistics, their 7/2, their July 2nd, 2020 report, which obviously has stats up until about 3 weeks prior to that. But you can see 88.9% employed, 11.1% unemployed, which is too high, obviously. But then you take that and you put that into its own pie chart, and 59.5% are considered temporary unemployment and 40.5% are considered permanent. So once again, even most of that 11.1% is considered temporary. It's probably why we're getting so much consumer confidence. People are going back to work. People are spending again. It's all kind of starting to happen here. Also, I wanted to mention that the unemployment rates are much higher in the younger population. Under 34 years old has market as much because most of the unemployed, the average age for a first-time home buyer now is about 33 years old. So most of these people haven't bought a home yet, don't own a home yet, don't have equity, aren't going to be forced to sell. A majority of the homeowners are over here which have less unemployment statistics. Well, what about forbearance? Forbearance is the buzzword. It's the buzzword. It's the people who have homeowners who have decided to not pay their mortgage for a month or two to go on the forbearance program. Well, of all active forbearances, 77% have at least 20% equity in that home. And what that means is that they have options. If they do choose to sell, they can still sell. It's not a foreclosure. They're not going to get foreclosed upon. But the great stat with regards to forbearance, and I'll actually go forward a stat here. Let's actually go back. Let's go back a little bit. So 77% have at least 20% equity. But if you want to up that, you can see 77 plus this 13% here. About 90% have at least 10% equity. And in the South Bay, that's important because the South Bay, even to get your entry-level condo in Redondo Beach is $500,000, and that condo 10% equity is $50,000. So people have equity, people have extra money. 42% of all homes are owned free and clear. Now, this is an amazing stat because this is how everybody's been so conservative since 2008, that they've put themselves in great positions where they're not struggling with regards to their mortgage, and they can reach in and take advantage of the lowest interest rates since the caveman right now and pull out a little bit of money if they so need it. Almost 60% of homeowners have at least 60% equity. I mean, that's a great statistics. And we know that all of these homeowners since 2008 have really deserved their loans, because if you talk to anybody who's gotten a loan in the past 10 years, they'll tell you it wasn't easy. Like they want all your paperwork. They want to know where every expenditure on your bank statement goes to. So pre-2008, this is the Mortgage Credit Availability Index. So how available are mortgages? How many people are eligible to get them? How many programs are there available that are willing to give a potential purchaser money? Tons and tons. Hey, we'll give anybody money. You have a pulse, we'll give you money, right? But since then, with government standards, with everything they've put in place, the Dodd-Frank Act, this has stayed relatively low. So every time they institute a new program, the headline is, oh my gosh, we're now allowing borrowers up to 50% debt to income or something like that. This is scary. In reality, it's never gotten anywhere close to what was going on there. Banks have been pretty conservative. Well, they've been forced to be pretty conservative with the regulations that are in place on them. So the high level equity provides options. And these options will provide the options to not go through foreclosure with regards to the forbearance. We can extend the forbearance. They're talking about an extra 365 days. So even if a homeowner lost their job, went into forbearance, and isn't going to get that job back, they still have a year to make up those payments. And there's talks now that they're going to extend it. So that means it might be 2 years down the line. They can modify their loan, what's not on here is policymakers can be working on policies today, tomorrow. Everything changes, right? Tomorrow, this could all change. But policies could come into place that will help these homeowners if they are in trouble. But as we said, most have equity. And they could sell the home. If you have a bunch of equity in it, you could sell a home, pay an agent, and still walk away with a little bit of cash. But this is a slide I want to get to. This is important because you can see the number of mortgages in forbearance fell for the second week in a row starting in July. So this is still a big number, but it's going down. And what that says to me is people are going back to work. They're making money again. They're spending money again, like we saw in the V earlier. So this trend line, if this continues to go down, it's a great thing. It's fantastic for the country. Okay, still no inventory. So why are homes still selling so aggressively? Why is the median days on market 13 in the South Bay? Well, we have no inventory. This is the available listings since September 2019. So this is the 2019 line, boom, and the 2020 line, boom. As you can see, listings go up in June, July, August usually, and then come down. But then here, this year, we're so low on listings. We haven't had much to sell in a long time. And because of that, there's multiple offers on a lot of them. Here's the year over year change in listings. So here's the new listings, and then we're down 15%, 20%, and we're down on the listings we had as opposed to last year. Inventory is about half of what it usually is as a percentage of the income or the households in the United States. And then housing inventory has been low for a long time. This is nationwide, 4.1 months, but I showed you the stat for the South Bay earlier. It's 3.2 months in the South Bay, so it's even lower than that. So this is an interesting one because inventory tightness is great for home prices, right? There's a lot of demand out there right now, but there's not much supply. When supply is low and demand is high, prices go up. But it also means that you're going to get those headlines moving forward, and you're going to get people to tell you, hey, home sales are down. Can you believe it? Home sales are down. We must be going into a recession, or home sales are down. The housing market must be struggling. Home sales are going to be down. There's less homes to sell. There's less homes to buy. So yeah, just be ready for that. Home sales are down. They're down across the board. I just showed you in this last slide that there are half the amount of listings to buy as there usually are. So home sales are going to be down, but that doesn't mean demand is down. That doesn't mean that homes aren't selling. But yeah, the gross number of homes sold will be down all year until we get those listings. Is it a great time to sell? Heck yeah. We have no month supply. So there's a lot of demand right now and there's a little bit of supply. You have no competition. If you put your home, like if you have a small house in Redondo Beach under 1,000 square foot, under $1 million, that home will sell immediately over asking. There are tons of people looking for it and there's nothing available. Same thing in other price ranges as well. So that your home will sell. It's a great time to sell if you're looking to do that. On average, I laugh at this, nationwide, there are 3 offers on a home that's closed in May. This is from the National Association of Realtors. Here in the South Bay, on average, we probably have more than 3, especially in the really competitive markets. But somehow, is it a great time to buy as well? Yeah, somehow it is. And the reason for that is because rates are so low. It's the cheapest time since they've been recording the metric in 50 years. It's the cheapest time to buy a home. So that's why demand is so high right now, because interest rates are crazy low. It's incredibly cheap to purchase a house. The percentage of income needed for a mortgage payment is historically low right now. And this is what it was in 2018, June 2018. It's just come down. It's the cheapest time to buy in the 50 years they've been recording the metric. And then because of that, home appreciation is what everybody expects. Pre-COVID, they're expecting a lot of appreciation in the next 2 years. Post-COVID, not as much, but they're still expecting appreciation. You can see that here in the main Fannie Mae, Zelman, National Association of Realtors. They're mostly expecting appreciation here in the next couple of years, because also we have the next big group of people, the millennials are coming. They're all turning 33. They're all starting to come right now, the big chunk of them. So yeah, that is the state of the market right now, both nationwide and the statistics here for the South Bay. I want to say thank you so much for joining me today. I really appreciate you watching. If you have any questions, please feel free to reach out. You can either write a comment in this post, or you can email me at garrison@soldbygarrison.com. I'll talk to you next time. Like me on Facebook, or like my page on Facebook, friend request me. We have discussions on there. You can also follow me on Instagram @soldbygarrison. I look forward to meeting you, and I hope you found this valuable, and I'll talk to you next time. Thanks a lot for watching.